Good morning, everybody. Welcome to Central Valley Score's presentation of their financial projection template. My name is Bob Garcia. I am co-chair of Central Valley Score, and I've been a volunteer for approximately 6 years. My background is banking, and I was the CEO of a company called SenCal Business Finance Group, which processed small business administration loans. So I'll be your presenter today, and we're going to talk about the Score's financial projection template. It's not designed to inform you how to obtain your information. The information for this demonstration is a combination of a made-up business, information from a business that I owned in the 80s, and today's expenses, for example, minimum wages and things like that. So my business that was purchased from another owner, so there was a history with that, and it was a franchise, and so I was able to get information from the franchise in what to expect when I bought it. From the very start, the simple steps to starting your business series, which tomorrow is the final episode, so to speak. We're going to talk about funding sources, and I'll also be giving that presentation. We've always and strongly encouraged you to investigate your business and industry to obtain as much information as you can, whether you've obtained it from a franchisor, from the library, from your competitors, or whatever. The more information you have, the better equipped you'll be able to make your business a success. The projection template that we're demonstrating today is a useful tool, and it should give you a financial picture of your business, but it's only as good as to the accuracy of your information. So what I'm going to do to start is we're going to launch a quick poll and ask a couple of questions, and we use this information for our own benefit for future polls. Christina, would you start that poll, please? Okay, just a couple of quick questions. Your business is established, yes or no? It's a startup, yes or no? Or you haven't opened it yet? And secondly, have you prepared financial projections? Regardless of where you're at in your business life, have you started it? Okay, what do we got here for answers, Christina? Is this it? No one's business is established. Somebody's got a startup, and most of you haven't opened yet. And one of you has prepared some projections. That's excellent. Okay. All right. Okay, so let's get out of that. All right, we're going to start right from the beginning. We're going to screen share. And what I want you to do is I want you to go to the SCORE website. That is score.org. And from there, you're going to go to the home page. And in the search box, you're going to go financial projection template. I can't see. And there you go, the template. Okay, click on that. And it's going to ask you to download this template. But before you go there, I want you to scroll down. And if you have problems with the template, you shouldn't, it's pretty self-explanatory. There is a guide, English and Spanish, and you can download that for information on how to manage the template. So you download the template. I was telling Christina, who's our manager of SCORE, that this comes up. This is not what you want. This is just for viewing. You go up to the right-hand corner here and it says download. You want to download that, and it will load it. You open the file. I've got two of them because I've been practicing, and it's an Excel spreadsheet. It's what it is. And if you're not familiar with Excel, don't be worried about it. There's only a few things that we're going to do that that you really need to know about Excel. But this is the worksheet. This is the information that you are going to use and put in here, and we're going to show you how this works. First of all, I am the presenter, so we're going to put Bob. This is important here. My company used to be a microwave store. In 1980, I owned a franchise called Friedman's Microwave Ovens. I owned we had 2 locations, Visalia and Fresno. And in 1980, microwaves were a brand new thing. It was a growth industry. And I purchased my microwave business from somebody who had been in the business almost 2 years, but he had to sell it because he had some financial issues. And so I took it over, and with his history of sales and expenses and help with the franchise, this is how I came to determine that I could make a living owning my own business. And I owned it for about 5 years. And there are various reasons why I got out of it, but it was it was quite an experience. And so if you haven't opened a business or been in business before, you will find that it's quite an experience also. This part is important. The starting month, because this tracks all the way through. We're going to start in January, just for lack of a starting point in years 2022. All right, you'll see here color coding. The dark colored cell is where you input your information. The light colored cell is there's already information in this cell and you can adjust it. And we'll talk about how you will do that. And then we go forward. And so I want you to do that. And then, oh, Christina, you know what the problem is here is I have all this information about muting, and I can't see these cells down below. Down below, you should be seeing things like projections and starting point, payroll, stuff like that. My view of this is not very good. But
you can click on that toolbar and move it up to the top, I believe.
How do you click? Just click on?
Yeah.
I don't see where that is happening. Well, we'll see what we can do. Okay, so the starting point here. For those of you that are home-based business, you are going to obviously need some equipment, probably a computer, a laptop, a printer, cell phone, whatever. But these are the initial costs that you're going to incur, and when you start your projections, you will put it all in here. For me, my business had a storefront, and so I needed stuff like leasehold improvements and equipment and what have you, and they're divided between fixed assets and operating assets. So my leasehold improvements started out at I believe $10,000. So we just entered $10,000 here. My equipment was $5,000. You just enter it here. Furniture and fixtures were $3,000. So my total fixed assets were $18,000. My operating cap, you got pre-opening salaries and wages. You know, this, for example, if you're a restaurant and you're having, you've got to train people before you open the doors. You got to pay them. This would fall in here, prepaid insurance. For me, inventory is what I needed. And that amounted to $10,000. And legal and accounting were $2,500. Now, if you make a mistake, like I just did here, $2,500, you go up to the top up here, you click on the cell where the mistake is made. And then you have to go up to the top where see my cursor at the top, and then that's where you make your correction and you hit enter. And that's the way you make your corrections in these cells. My rent deposit, my rent was $2,500 a month. I got first and last, so it's $5,000. Utility deposits were 2,500. Supplies, 2,500. Advertising and promotions, this is going to be big. It's $10,000. Licenses, $1,000. Initial startup costs. This is just a catch-all for anything else. And how much working capital do I need? This is a guess. I'm putting in $25,000.
Hey, Bob, sorry
Yes.
to interrupt. So somebody's asking, do you enter the amount of the salaries and wages you plan to pay for the whole year, or is it by month?
It's by month, and I'll show you how that works when we get to that screen.
Perfect.
Okay. So in order for me to open my business, I need $79,000. Where am I going to get it? Well, I got 50. Yes.
It's by hour, and the total numbers of days they work will populate the screen for you.
Yeah, I'll demonstrate that in a minute. Okay, so I've got $15,000. That is my equity injection. I will tell you, and I'll explain this tomorrow in funding sources, if you attend, there is no 100% financing. You have to make a contribution. That could be anywhere from 10 to 30%, depending on the type of loan program you are using. But we'll explain more of that in tomorrow. But my equity injection is 15%. Right now, it represents 18.99% of the total amount that I need. So I am short $64,000. Where do I get it? Well, I'm going to get a commercial loan, and I'm going to put in $64,000. So now it balances the required funds versus the source of funding, $64,000. Next to that, you see that the loan rate is 9%. I think that loan rate's a little high. So I'm able to adjust that. You go up to the top. I think it's going to be 6%, 0.06 is what you put in, and it adjusts it. It's for 84 months. And as you can see, I'm really having a problem with this, Christina. I don't know how to get it to the top. And I can't see how to move my, oh, there we go. I did it. Never mind. Okay, and so you move this. Still, that's a problem. So you move it over, and my payment is $935, and that's important because that'll track later on. Okay, so this is my starting point, and then we go to payroll. Somebody had a question about that, and we do it by hours. Who are you going to pay first? We're going to pay me. I'm the owner. One employee. You move it over. How much am I going to get paid? I think I need to make paid starting out $50,000 a year. That's about $25 an hour, and that's what you put in there. Actually, that comes out to about $52 an hour. 40 hours a week. Well, I'm going to be full time, and I'll put myself at. I will tell you now that you are going to work more than 40 hours a week, and there you go. It populates. 43.33 is what you are going to be paying yourself a month. Not only that, if you scroll down, it includes taxes, and then it does this for you. Your Social Security, your Medicare, your federal unemployment, your state unemployment, and you are able to put anything more in here if you have a pension program, workers' compensation, what have you. So so these are the taxes, and so your total payroll for yourself every month is $4,688. For me, I'm going to have one full-time employee because I'm a small shop. Minimum wage in California is $14 an hour, and they're going to work 40 hours a week. There you go. That's what I have to pay my one-time full-time employee. Now my payroll is at $73.24 a month. I have one more part-time because I don't think we can do it that way. Part-time of $14 an hour, and that person is going to work 20 hours a week, part-time, and there it goes. It's populated. So my payroll every month, including taxes, is $86.84. Total payroll for the year is $103,850. a lot of payroll. And that's just for 3 people. Can you imagine? Okay. And if you click on this bottom line at here, payroll for years 1 and 3, there you go. It automatically populates a rate of 1 and 3. Now, it automatically gives you a 20% growth. You think you're going to pay your, give your employees a 20% raise or yourself a 20% raise? Probably not. So you can adjust that. You can click on this, go to the formula up here, and you can adjust it. And let's say it's 5% raise, so it's 0.05. The same for your full-time employee, 0.05. And your part-time employee, 0.05. You're going to give just a small raise for everybody. And you can do that for the 3rd year. You can see where it still has 30, 30, and 30, but you made those adjustments. So your total salary is 103 for the 1st year, 110 with a 5% raise, and it jumps to 143 because we have not adjusted the growth rate at 30%, but you get the idea. Okay. Pretty simple. Now we're going to take you to the sales forecast. This is depending on the kind of business you are. You use the product lines here. If you have a lot of product lines, you're going to have to consolidate some and determine how you get them, because I can't add any more lines. For me, my main product line was a microwave oven. So we're going to put microwave right in here. Okay. And the unit sale price was $400. In 1980, it sold for $400. It cost me $300. My profit margin was $100 per oven. Pretty simple. Now, for me, that was the main product line. Everything else that I had in the store supported a microwave oven, dishes and utensils, everything else, recipe books, everything else supported a microwave oven. So I called it miscellaneous. And I was told by the franchisor and the person that I bought the business from that my miscellaneous sales averaged 40% of whatever the microwave sales were. And that the average item cost was $40. So it was $40. That's the unit sale price on average. And I had 100% markup on everything else. So it cost me 20. My markup was 100%. The average item that sold was $40. So as you can see, my margin per unit was $20. And these titles under the product line go down. If you scroll down, they go down to the month. And so let's tackle January. I was told, the franchise told me, the seller told me that I was going to be profitable only 5 months out of the year. And that was kind of disappointing. That I was going to lose money 3 months out of the year. And that everything else was going to be break even. But what's break even? They said it's about 50 microwaves a month is break even. And I'll show you how, this is what they told me, and I'll explain how I got that. So in January, so what is it? You're going to be profitable November, December, and January. Those are the holidays. January is what's left over from the holidays, but it is a big month. February, you're going to make money because of Valentine's Day. In those days, a Valentine gift was a microwave. Beats me, but not very romantic, but that's what we're told. And that actually worked out. And then June is Mother's Day. Those are the days you're going to make money. So how much money are you going to make? How many sales you're going to have based on the seller's information, looking at their advertising and marketing, promotions or whatever. I determined that in January, I could sell 100 microwaves. So you put in 100 microwaves there and just enter it, and it automatically populates for you. Pretty simple. In February, I'm going to sell 85 microwaves. Based on that information. March, I determined is a break-even month. They tell me it was 50 microwaves. April, a break-even month, 50 microwaves. May, same thing. Just enter that in there and it automatically pops it. June, I'm making money. Hot damn. I determined I was going to make sell 85 microwaves. Not a whole bunch. July, 50. Now August is the time I'm losing money. How much money am I going to lose? Well, based on the seller's information, I'm only going to sell 35 microwaves in August, 35 in September. Oops. 35 in October. November, Christmas is coming. I'm going to make 100 microwaves. December, the big month, 300 microwaves. Hot damn. Scroll to the end. I'm going to sell 975 microwaves. I'm going to have revenue of 390,000, cost of 292. I'm going to make a gross profit of $97,500. Pretty simple. So let's go back. Okay, my miscellaneous represents 40% of the microwaves. So in this case, I had to work backwards because the only information you could put in here goes in this cell, and you had to determine out the number of units sold. So in this case, I had 40% of $40,000, which is $16,000. So if you take $16,000 and each unit costs 40 bucks, you divide it by 40 and it's 400 units. And so $16,000. So you can see I had to work backwards on that. Same with 34,000 units times 0.40%, which is 13.6 divided by each item was 40. So it's 340. And you can see how I did that. Same with March, I sold 50. Oh, excuse me, not 50, $20,000 worth times 0.40% divided by each item at 40, that's 200. So you need to determine you know, your unit cost. 200 again. 200 again. Whoops. 85 was 340. 200 again. Let me move this over. 35 microwaves, $14,000 times 40%. That amounted to 140 units. 140 units again. What do we say? $40,000. $400. And then Christmas, I had $120,000. So it was 1,200 units. So that's a lot. Okay. So then you scroll over to the end, and you have you sold 975 microwaves. You sold 3,900 other stuff. I have made a mistake here. No, I'm good. Yeah. Okay. And so $78,000 was your gross profit there. 97. You scroll all the way down. You sold a total of 4,875 units. Revenue is $546,000. Your cost at 370. you made $175,500 in gross profit. Sounds pretty good. But remember, you got payroll here of over $100,000. Okay. So really, you've got about $75,000 to pay your expenses in throughout the year. If you take it forward for years 2 and 3, there's scroll back. Years 2 totals, and it's an automatic. And you go over here. They've given you a 10% growth rate each year, and that's how they have arrived at those. And you can adjust those. You think your growth rate would be more? You just change it. Just click on it, go up here and change it. It's up to you. Obviously, you want to be realistic. So let's use 2 and 3. This is stuff that it obviously populates for you. This is stuff that you give your banker when you think you're going to need a loan. Now you got something here called additional inputs. Very interesting stuff. If you're in the business that is going to carry receivables, you're going to extend credit. It's highly unlikely that if you extend credit that you're going to get paid by everybody every 30 days. And so you look at your industry and see what the industry averages are. And you make those adjustments here in additional inputs. If your industry says, you go up here, you recalculate. If your industry says that on average within your industry, people pay, 60% of the people pay within 30 days, you just put in 0.60. And there you got 60%, which leaves then the second space, then 40%. Everybody else is going to pay within 60 days. And so it does 100%. This is important because it affects your cash flow and how you receive money. Okay. So then payables, I'm assuming that this works the same way. I'm assuming that you're going to pay your payables every 30 days. And so there wouldn't be a problem. So let me readjust this here for my benefit. I get put this down to 0. Just give me a second here. So now, one thing this template does, it assumes that you have a line of credit to cover any deficiencies. I don't like using that because it really doesn't give you a clear picture of whether you're making money or not, and certainly affects your cash flow. It automatically kicks in if you're short of money, and I don't like that. I like to see the true picture, really, if I'm short, how much I'm short. So what you do here is a little bit of a fix. What you do here is you click on a desired minimum cash balance, and you actually put a minus 100,000, and then you put a 0 for this interest rate. And that gets rid of that line of credit. And I would encourage you to do that. Remember that quick fix. If you think you don't need to, if you think really that you need a line of credit, go ahead and leave it alone and you'll be fine. If in fact you think, you look at these categories down here, I've scrolled down to fixed assets. These are the assets that we put in when we open the doors. 10,000 in leasehold improvements, 5,000 equipment, 3,000 in furniture and fixtures. If you think that you are going to buy more equipment, let's say in May, you stick it in right here. Or you need more FF&E, you stick it in wherever you're going to buy it, and it makes that adjustment down the line. Don't worry about, as I scroll down to income tax assumptions, don't worry about that. I never in the first 3 years worry about income tax because I'm probably not making all that much money. Okay, so this is really where everything gets interesting in terms of your break even. And so what are your operating costs? And I'm really going to simplify this. So I'm going to spend about $500 a month on advertising. Just stick it in there. I have no car and truck expenses, no commissions, no contract labor. Insurance is about $250 a month. I don't know if it is. I mean, just making that up. Legal, license, office expense. There's always office expense of $1,000. Rent or lease machinery, no. My lease on the building is $2,500. Repairs and maintenance, supplies, there's always a need for supplies of $500 a month. Travel, meals, utilities, do I have anything utility? I do, I have $300 a month. Theoretically, my monthly bills to run that, my office, my location is $5,050 a month. This is why they told me that my break even was 50 microwaves a month. It covers this 50 times my gross profit, $100 is $5,000. What they failed to tell me is that, whoops, I've got payroll also, but it's not included, but we'll cover that in a minute. Down here, if you scroll down here, it automatically depreciates a straight line depreciation on those fixed assets that you put in at the beginning. Leasehold improvements, equipment, that stuff. It automatically calculates that for you. You see, it's all white. There isn't anything to move it. That commercial loan of what was it, $64,000? This is the interest on it. When you make that payment, what was it, $950? Of that 950, 320 is interest and the rest is principal. And it automatically reflects that down here. So total other expenses. So in addition to your operating expenses of $550, you got with depreciation interest, $55.99. And as you can see, it adjusts. Okay. Now, you need to carry this through the year. And this is kind of handy here. Let's see if I can do this here. There we go. Okay, so Excel, you can do this. You can manually put in 500, 500, 500, 500. Or you can use the Excel spreadsheet, and the way that works. You left click this, scroll down. Okay. Then you go back up to January at the 500, right click, and you want to copy it. You see how it all lights up now? So then you go to February and you left click it and you scroll and you cover all the space here. Okay. You go back up to February, right click, and then you paste. Voila. There you go. It's all done for you. And to get rid of this outline here, you just hit escape. That's one of the tools that Excel has for you. If you don't know how to do it or you don't care to do it, you can put it in line by line, column by column, cell by cell. It's up to you. You can actually do it one line at a time. But for our purposes, that is your how you do it month by month. Your operating expenses, including depreciation and interest, is $66,977. All of this is forwarding. You go to the next couple of years, and they got growth rate of 3%, 3%. It's automatically done for you. Easy peasy. That is all the information you need to put in. You don't have anything more to do. It's populated everything for you, and let's go to the cash flow. I'm going to tell you tomorrow when you tune into funding sources that 99% of the time, the loan you're going to apply for is a term loan, as opposed to a line of credit. A term loan is a loan that has a maturity of at least 12 months or more. You're going to pay it monthly, and you're going to pay it from the cash flow of the business, not the profits, the cash flow. And this statement right here will tell you if you have enough cash to pay your bills. You don't necessarily have to be profitable, but do you have enough cash? Remember that $25,000 we started out with in the beginning? That was and I guess that I would need working capital of $25,000. This is the way the cash flow statement works. In January, you had sales of $56,000. That cost you $38,000. Your operating expenses were $5,050. Your payroll, you and your 2 employees, is $86.54. That includes taxes. Your loan payment, remember that loan payment of $64,000, $935. So you had income or inflows, as they call it, 56. You had outflows of 52. Hey, you had enough money. You had money left over, 3361. What do you do with it? You add it to the 25 up here, gives you 28. You take that 28, you take it to February. Now you have cash of 28,000. You had sales of 47.6, costs, all these costs. 46,939. You had $661 in cash left over. You add it to that number of 28,361, and you have 29,22. Now in March, a little bit different. You had sales of 28,000. You still have costs 33,639. Now you're short $5,639. But we have cash of 23,383. You have cash to pay it over. You take that cash, take it to April. And so you can see how this works. Inflows and outflows. Let's go over to September. What do you got here? Got some negative numbers. You're short of cash. You see these numbers, you can't pay them. So you have some choices. You can inject your own money, or let's, for our purposes in this demonstration, let's go back to the starting point. Remember I said I need $25,000? That's a little short. So I'm going up here to working capital, and I'm going to say, okay, instead of borrowing 25, I'm going to borrow 35. Let's see, what does that do? So there's my 35, and I got to come down here. I'm $10,000 short, so I have to borrow $74,000. Does that work? Well, let's go see. Let's go find out. No, I'm still short. Look at this, $9,000 in November. All right, do I want to borrow more money? How much more money do I need to borrow? Well, instead of borrowing 35, let's borrow 45. This is getting a little ridiculous now. So then I got to go down here. I got to borrow, instead of borrowing 74,000, I am now borrowing $84,000. My loan payment has been adjusted. For 7 years, it went up from $950 to $1,227. Everything has been adjusted for you. It's carried it forward. Let's go to cash flow, year one. I'm still short $800 in November. I can live with that. So it gives you, it automatically adjusts for the things that you need to do. You need to have a positive cash flow. And this is it. And right about here, because we eliminated that line of credit. See, if I would have kept that line of credit in there, it would have added money for you, but realistically, you're not going to be able to get a line of credit in the term loan. And this is where you're at in December. Okay. And it carries it forward to cash flow years 1 and 3. You made a lot of money in December, and it carries it forward to $41,000. Okay. 41,000 right here. That's what you made in December. You started out the month of December, but it's your big month of 22. You had $2,200 in cash, but you made 300. You sold 300 microwave ovens and a lot of miscellaneous accessories. So you got $41,000 in cash. It carries it forward, and so you can take a look at year 2. You run short again in November. October is really when you're losing money. August, September, October. You're paying out cash to cover those, and you just wind up short. You're $1,000 short according to this projection. Okay. Let's go to the income statement. This is kind of small. This is for the first year. Based on the information that you have presented right here, net profit, a loss of $5,129. Let me go off script here for a minute, because I talked to a lot of clients who do this and does wind up a loss. And you can, it's easy enough to go back and increase sales. I mean, you can put in any number you want, but you need to be realistic. You know, can you really sell 300 microwaves in as a specialty store in the month of December? The answer in reality was yes, I did for the first few years. But you know, the other months contribute to the total profit and loss. And you need to ask yourself, okay, I've got a $50,000 plus salary. For a lot of people, that's good enough. But you're in debt $84,000. And according to these projections, you're going to lose $5,000. In the Simple Steps series, at the end of each session, we say it's a go or no go decision. And so you, in the beginning, you have an idea of what you want to do to get into business. And you take the first class with the information that we give you. At the end of that class, we want you to ask yourself, based on this information, do I still want to go into business for myself? And if you say yes, it's a go decision. And at the end of each of those classes, we ask that question. And the financial projection class that Gary gave last week supports this. When you actually get down to the numbers. And if you think that your numbers are realistic based on everybody you've talked to, everything you've read, if they're really accurate, maybe you need to go into a different business. I'll tell you, owning a business, nothing made me feel better than saying I was the owner of a successful company that was making money. I was paying my taxes. I was employing people. You know, I was on the plus side for economic. What am I trying to say? Economic development, positive side for the community, and nothing makes you feel better. But you know, you're at a risk here. I'll tell you, if you're a startup business, you borrowed $84,000. They're going to put a lien on your house as collateral if you own property. So you got a lot of risk, and that's because I had to borrow some money, and they put a lien on my property. And if it hadn't worked out, I mean, I've lost $5,000 here. You go to the second year, maybe it's a little better. You made money, but you lost $10,000 in the third year. And that's because, if you remember, when we went back to the salaries, we were giving everybody, I didn't adjust the third year salaries. We were giving everybody a 30% increase in salaries. But it's a fragile situation. $5,000 is what, maybe 10 microwaves. And so you can go back here to and adjust that. I mean, if you sell 300 microwaves, can you sell 350? I mean, can you? You can go back here and you can adjust this. Let's put 350. What's that do for you? Come back here. I'm break even. 129. I've lost $129. Break even. 50 microwaves for a month. That's the difference between you losing $5,000 and breaking even. Can you do that? I don't know. For me, when I bought the microwave store, he was averaging 35 microwaves a month until he hit the holidays. I needed 50 because I borrowed some money. And could I sell 15 more microwaves a month? You got to make those decisions. Okay. So you broke even. That's the income statement for year one, income statement for year 2 and 3. This is all the information. If you go borrow money, you give to your banker. The balance sheet, I will make the statement tomorrow, and I've made it a number of times. Business owners do not use the balance sheet often enough to manage your business. For me, it was critical. This right here, using the balance sheet, I could determine my inventory turnover. I had 10 manufacturers. Each manufacturer had 5 models. I had 50 different microwaves on the floor. Using the inventory turnover ratio, I was able to determine which manufacturer was selling the best, and within those manufacturers, which model was selling the best. So obviously, I bought more of those that are selling the best, and some of them, the models that weren't selling at all, I just didn't carry anymore. You can use, if you have receivables, If you're carrying receivables, you can use the accounts receivable turnover ratio to determine if you are within industry averages in collecting your receivables. And when you apply for a loan, we're going to ask for a schedule of accounts receivable and a schedule for accounts payable. We want a list of people who are your customers, how much they owe you, and are they current, or are they late 30 days or late 60 days? If anybody's late over 90 days, I don't give you credit for. The next one, and so right here, your equity. We use this as a banker. We determine make a lot of ratios, current ratio, debt to worth ratio, to see how strong your company is. And all that's done for you. Let me go forward here. This is a break-even analysis. It's all done for you. You have to sell $44,936 every month just to break even. Can you do that? Some months you can, some months you didn't. November, December, and January you did, but you certainly didn't do it in July, August, and September. That's your break-even analysis. It's all done for you. The financial ratios, what do they mean? You need to know what they mean, because I as an underwriter, I look at this current ratio, and what is the current ratio? Well, you can go over here, diagnostic tools, you go over here, current ratio. Owner's cash injection. Oh, that's the current. Where's the current ratio? All of these, I can't find it. All of these talk about what these different ratios mean. My injection was $15,000. Is that enough? Well, because I kept borrowing more money, it represented 15%. Owner's injection might be too low in relation to the amount of money needed. The commercial loan interest rate was reasonable. The loan term was reasonable. Debt service coverage ratio 3.5, calculated loan payments relative to operating. So this kind of explains everything that you need, but you should know this. Is the current ratio within industry averages? Is your debt to equity ratio within industry averages? If they're not, why not? Okay, cost of goods to sales, 68%. Remember the cost of goods for a microwave is 75. It was 100% markup or 50% cost of sales, and so they average it out here. Is that it within industry averages? If it's not, why not? And you need to know this. And the diagnostic tools. From there, I don't use the calculator, the cost of goods calculator, because you've already got that. And the amortization table is here for your loan. It's $84,000 at 6%. And then it breaks down interest and principal monthly, year 2, year 3. This is in my opinion, a good tool for you to use to see if you can make money. Everybody's goals are different. If you're happy with $50,000 and you're breaking even every month, or excuse me, every year, life is okay. If you want to get rich, don't sell microwave ovens. You want to make when I went into business, I wanted to make a better than average living. I was a banker. I was a credit officer. My wife managed the business. And so after work of banking, I spent the next 3 or 4 hours at the microwave store, because we closed at 9 o'clock, doing selling, repair work, or whatever. I think we all know that you're not going to work. If you own a business, 40 hours a week is not realistic. You're going to be working more. But getting back to this tool, when I did this in 1980, I did it all by hand because we didn't have tools like this. This is a tool for you to use. I don't want you to get hung up on the Excel spreadsheet itself and how to use it. You don't want to fight with the software. You want to be able to enter this information. But it's a powerful tool and it makes things go a lot faster. I'm open for questions now. If you got them in the chat box, or put them in the chat box. we can see if I can answer something. Christina, do we have any?
Yeah, so before we get to questions, Bob, we just like to do a quick exit poll. So I'll go ahead and launch that for everybody now. Just two
Sure.
questions. We would like to know, did you find today's webinar helpful? And would you like to request a SCORE mentor for this topic?
We encourage everyone who's starting a business to at least talk to a mentor, to bounce off your plans, your ideas. We're here to give advice, not legal advice, but we're here to give advice. And my background is banking, and having owned a retail shop, I've got some information on that. If you need information on marketing and advertising, we have people with backgrounds in that, and you can talk to them. The SCORE website is a very powerful website. It's got more information than you could ever hope to see. Webinars are there, and we conduct webinars at our local level like we're doing right now. Okay, I'm glad everybody found it helpful. Thank you. Requesting a mentor, yes. And the way you request a mentor is go to the score.org website, and you can request a mentor. And in theory, we'll get to you within 48 hours. I say within theory because sometimes we're short of mentors, and the demand gets a little high. But we'll get to you, and we will help you as much as we can. Okay, do I hit the stop sharing there, Christina?
Yes, I went ahead and did it.
Okay, there you go. Okay.
Perfect. So somebody's asking, Bob, are we going to get this Excel spreadsheet? Yes, I'll send it out to everybody along with the link to the recording for this webinar.
And remember, when you get to that page where the template is, you download, you can scroll down and you can get instructions on each page. And so don't forget to do that if you have any problems. Anything else, Christina?
Let's see. So somebody asked if they need a template from SCORE that has a 5-year plan. Do you know if they will be creating that at any time soon?
Not that I know of, but this only takes you out, as you can see, for 3 years.
You or Bob do a stop share screen? There you go.
Oh, there you go. Okay, that's a good idea. 5 years, no, I don't know that they'll be making a 5-year plan. As an underwriter, 3 years was enough. And as you can see, the first year is done by month, and then the second, third year is just annually, and that's sufficient.
For those that like to continue, after you do your second or third year, you can maintain that and then add the next 2 or 3 years on there if you want a longer history of sales records.
When I owned my business and I was doing it by hand, I tracked it monthly for about the first 6 months, sales and expenses, make sure the margins were what I thought, and they weren't. It changes. And I've talked to other business owners and who have done this. It changes, and you got to make those adjustments. Having a template like this really makes it easy because it populates those changes, and you don't have to go and do it manually. So I think this template is very easy to use, but some people will have a problem. And as a SCORE mentor, we can fix that for you. We can do this screen sharing with you one-on-one. So I would encourage you to use it.
Bob, that's a good point on your margins, especially today on the vendors. There's a lot of cost increases from your vendors and product you're delivering. So Bob, that's a good point to look at your margins more frequently, especially today.
And with the political picture changing, I mean, what is it, 1 or 2 years, you got to go to $15 an hour. How's that affect you? Well, you can put that $15 in there, and so what are you going to have to change? You increase my margins. One of the reasons I got out of the business in 1985 is because the margins got too skinny. When I bought it, I was getting $100 an oven. When I left it in 85, the margins had shrunk to about $60. I couldn't sell that many more ovens. My competitors were Sears and Montgomery Ward's, While I'm selling 50, 60 microwaves a month, they're selling 200. And you can, the volume that they can purchase really allowed them to sell it at a cheaper cost. And so I could see where the industry is going. So I had to get out of it. And that's what you need to do. We encourage you to keep looking at your industry, see what changes are, and make those adjustments. Anything else?
No, it doesn't look like we have any more questions there, Bob. So
Okay.
again, I'll send the blank spreadsheet to everybody along with the link to the recording. And we hope to see everyone for tomorrow's session for
Yes.
funding sources.
Funding sources. We're going to talk about we're going to talk about your sources, banking and non-banking. So we're going to talk a little bit about crowdfunding, venture capitalists. It's really a catch-all. But the most important thing that we're going to talk about is what you present and what your banker is going to look at. And you need to be, I mean, you want to answer those questions before they even ask them. I think it's a webinar that's well worth attending if in fact you think you're going to need some financing, whether to start your business or to expand your business. I hope to see you tomorrow.
Yeah, and I will send the link to register for that webinar in case you haven't registered yet.
Okay,
So,
great.
Thank you, everyone. Thank you very
Thank
much,
you.
Bob.
Bye-bye.
Bye.